The realities of investing in property and retirement funds past your 40s. Is it too late or is it a smart move? Let's talk about it. Right guys, so let's be real. Some of us didn't think about putting anything aside for our retirement when we were in our 20s. No, we were out buying overpriced coffees, overpriced clothes, shoes, and just literally living life to the full and not even thinking about horrible time in the future, our retirement. So is it too late to start thinking about retirement and putting some money aside from now? No, of course not, guys. And this is something that I'm really, really passionate about. But first, we've got to look at the realities and just go through everything and make sure we know what's to come. So let's break it down. So guys, for ease, I've literally split this video into a few different talking points. First, the power of starting early and just looking at the numbers. And spoiler alert, for me, yes, it was those overpriced coffees, especially those overpriced pair of shoes. How investing in property is still a good move. The challenges that may come with investing later on in life, and the effects on small property businesses. And guys, you want to stick around to the end because I'm going to be dropping some game-changing bonus tips. So guys, let's start off and let's talk some numbers. So if you were to start early, then obviously, yeah, that is the best way to go. So if you are younger and in your 20s or whatever, and you are watching this, please think about this from now. This is something that I think about until later on in life, and probably most of us didn't think about till later on in life. You don't want to when you're in your 20s. You want to live carefree and enjoy yourself, which is why it's really good to use. So when you are a bit younger, you can probably just think about putting aside, I don't know, maybe 100 quid or something out of your paycheck, just going straight away into your pension, and you don't even have to think about it. That's probably the best way, because then you will benefit from the compounding interest as time goes on. So for example, if Ben starts investing at 20 and he's putting away £200 per month, for example, out of his paycheck into a pension pot, then by his 60s, if he's looking at maybe a 7% kind of return, then potentially he could have around £480,000 worth of a nice little nest egg by the time he's 60, if only, eh? But in comparison, if you are approximately, say, 30 and you want to save the same amount, then you might have to look into putting aside maybe something like £700 out of your paycheck, which is a hefty amount, every single month to even think of coming close to the same amount that Ben has, because Ben's benefiting from that long time in the market and benefited from that compound interest. Yeah guys, so that's nearly triple the amount that Ben would have to be putting aside. So yeah guys, starting late means that we have to really be more aggressive when it comes to investing and putting things aside. It's not impossible, but we have to be a bit more creative with how we're thinking about putting our money aside and what funds we're going to be investing into. But the main thing is, it's not impossible. So guys, why didn't we invest when we were in our 20s? I literally remember getting my pay packet every payday and thinking that, great, this is free money, this is a whole shopping spree. And fast forward to today, Instagram just makes us feel like every trip we're going to be going to Bali, sipping on a coconut, or you are literally failing in life. I mean, studies literally show that millennials spend at least £3,000 a year on non-essential items. £3K, with luxury being one of the highest items on that list. And it's great and all, it's lovely. I mean, not telling anybody how to live, it'd be brilliant to be able to do this, but we've got to also have some sort of balance and also think about what's going to happen when we do get older, which is really difficult when literally social media is literally pushing all of these visions of people, everyone you know, people that you don't know as well, all on holiday, literally living life and enjoying themselves. So basically, big brands and social media platforms have literally done a great job at convincing us all that short-term happiness and that real short-term dopamine hit is key, like purchasing those new shoes, and that all of this is better than long-term financial freedom, when nothing could be further from the case. And then when we all get older, we all get to 30, 40, and we see where all our money's gone, it just makes you want to cry. And guys, I do have more videos on how to start investing, or how I've started investing, and how I invest in property, and also more importantly, how to get started in investing in property by literally making sure that you have a solid financial foundation. So check those out as well. And by By the way, guys, my name's Sabrina and I'm literally documenting the whole of my property investing journey here on YouTube. So if you're liking this video, please like, comment and subscribe. Thanks. And guys, that literally leads me on to my next point of property investing. And I still think that this is a great move for people. I know things are kind of uncertain at the minute, but playing the long-term game, it's a great way to maybe get your foot on the ladder and generate that wealth for yourself. The best part about investing property is that it's never too late to start. As soon as you can start it, no matter what age you are. And as most of you will have seen that have followed my journey, I've kind of fallen into and my current strategy that I use for my property investing, and that's investing in mixed use commercial properties so that I can sort of get slightly cheaper, so I can help reduce sort of costs on things like, for example, stamp duty, which as of filming this video, as of the 1st of April, stamp duty has literally been hiked up on residential properties. And I do have a video going into more detail on stamp duty on my channel as well, so check that out. And rental income is also a great way of securing your retirement as well for you. And again, I've got videos going into more detail on what I'm going to do for my exit strategy once I get to the end of the mortgage term and how to pay that off. So if you're worried about coming to retirement and still having a mortgage to pay, you can check that video out as well. And also, guys, if you do want to start to get into property investing but you're unsure about your finances, you can always look out for Unbiased. They are literally like a matchmaking services for your finances. So if you do want to speak to somebody about your finances, maybe they're not where you want them to be for you to start your property investment journey, you can give them a call and just speak to them. And your first consultation is free. There's a link in my description box below if you want to check those out. And again, I'm making a small commission off everyone who signs up, so thank you. Okay, so let's be honest here, guys. I mean, it's not all sunshine and passive income. So investing later on in life comes with a lot more challenges. So higher financial responsibilities, you're forced to then invest more later on in life so you can build up that retirement pot. You might not have those funds available. Maybe you've got other financial commitments that you have got to adhere to. You've got a mortgage maybe, or rent payments, you've got children, you've got all the dependents, you've got everything else, other things that you need to pay for that kind of eats up or might eat up your salary, for example. So you've got less of that financial gap to spend on putting more away for your retirement. You've also got less time for the compound interest or that compounding effect to actually work. So because you've got reduced, amount of portion of time left because we've left it so late, then you've also got to run the risk of you might not have enough to pay for everything that you'll need in your retirement as well. So you've got to weigh one up versus the other. You've got less time, so therefore you need quicker returns. So, and that's not to say I don't want you to be even riskier, making even more riskier decisions. It just means that you're going to have to force yourself to see where you can cut back, where you can take the money from, because someone did say to me before, and this has always stuck with me, you either work hard when you're younger or you work hard later on. Pick either one you want to pick. And it's so true. So you either make things easier for yourself, or when you come to retirement age, because you're going to get there eventually, one way or another, it's going to happen. You could still get there and then make life harder for yourself, where you still need to stay in working hours longer because you've got less saved up. So either way, you're going to have to hit those goals so that you are more comfortable in your retirement, or you'll be working through your retirement, which I think is probably the government's goal anyway, is making us work for longer and longer than what we plan to. But okay, yeah, and like I've just said, having a more cautious sort of mindset, because when you're in your teens, 20s, maybe early 30s, you'll have less responsibilities, less dependence, so you've got more chance of taking those risks. Then you could always build those back up if something bad was to happen. Yeah, so obviously now that we're older, if anything, the worst were to happen, it's going to hit us harder because we're older and we're further along in life. Somebody that's in their 20s has got the better option and can sit and wait on their investment more than somebody that's closer to retirement that might need to see the actual cash out of that investment. So basically what I'm trying to say is they will have less flexibility. They won't have as much flexibility as that 20-something. And that's why making focused decisions and being very cautious is going to help you out more in the long run, because we want those stable, certain cash flows. So it doesn't mean that we shouldn't do something. It means that we have to be more strategic. And like what I always say with all of my videos, make sure you do all of your research before you make any financial decisions. These are just results and things that I display on my channel that work for myself. they might not work for you because you'll have different circumstances. So just make sure you do all your research, you speak to as many people as you can, and that you're covered and you make that informed decision moving forwards. This is by no means financial advice or anything like that. It's just my opinions. So guys, what's the takeaway here? Investing past your 40s isn't impossible. It's not too late. You just have to be more intentional and more logical with the decisions that you're going to make. Invest smart, focus on cash flow, and don't let past mistakes stop you from building your future. How to pay off your investment mortgage using an investment fund. Property investing exit strategy. Right guys, so today I want to talk about something that I don't feel that's spoken about enough, and that is your exit strategy for your investment properties. So a lot of us, if you are anything like myself, you've got your investment properties, and if you have got them through a mortgage funding, then chances are they're going to be on interest only, which is great because then obviously you're not spending as much each month. In itself, it's great because you're not spending that much, which in itself, guys, that's great because we're actually maximizing our profits because we are spending less on costs. But then because we're doing that, still got that whole mortgage that is still piling up and still going to be there at the end of the term. And if you're anything like me, for example, if you've got children or you want to actually hold on to the property and have that as a way to build wealth and also build generational wealth as well and pass that on to any children or grandchildren, maybe you're going to be wanting to think about adapting your exit strategy and what you're going to be doing when you actually come to the end of that mortgage term. So today I just wanted to have a quick chat about that and just share the strategy that I'm using so that hopefully by the end of the mortgage term, or when I come to retirement, or when I come to that place at the end where I want to pay off the mortgage because I still want to retain the properties, I've actually got my exit strategy in mind, and it's something slightly different. So I really want to share the strategy that I personally will be adopting and using so that my interest only mortgage that won't become a big problem in the future when it comes to the end of the term. So what we're going to be covering in today's video is what I'm doing to put a portion of money aside out of the rental, investing in long-term funds, for example, like Vanguard, and why I'm not solely relying on the investment gains, and hopefully the risks and versus the rewards of me using this approach. And of course, maybe how you can do the same with your properties. So hi guys, my name's Sabrina, and I've literally started to invest in properties over the last 3 years, and I'm literally documenting my journey here on YouTube via this channel. So if you like the content so far, please like and subscribe and maybe comment down below. So today I'm just going to be sharing my sort of quick game plan on what I'm doing in regards to my whole investment sort of plan. So the properties are literally a small part of the whole entire investment plan I have in my head, and it's part of, and as I say on this channel over and over, I'm wanting to diversify my portfolio and sort of put my money into not just property investing, also into funds like Vanguard, and hopefully using those to build up some wealth so that I can pay off all of these properties that are on interest only at the minute, pay them off at the end of the mortgage term. So whether you're a seasoned landlord or whether you're just getting started as well, maybe this strategy might help you out as well. So if you're anything like myself, if you are an investor come landlord and you have got your investment properties on interest only, but you might have thought, how am I going to pay this off when it comes to the end of the mortgage term, because you've still had that outstanding? And I know a lot of landlords are probably going to be relying on maybe selling the property at the end and then paying it off that way. But if you're anything like myself, as I've said already, I literally want to build my net worth, and I just want to build that and pass that on to my children. So that exit strategy for me is not going to work because I actually want the asset to pass on to my children as well so that they can benefit from that too. So my sort of game plan is literally putting a portion of the rental income into an investment fund or an investment plan like a stocks and shares ISA, and also putting a bit of that aside into my pension pot as well with funds like Vanguard. And so doing that from now, it's going to give me at least 20-25 years or more just to put some money aside, and then also I've got the returns on top as well. So hopefully that will build up to a substantial amount. Obviously at the minute things are taking a bit of a turn on the stock market, but overall by the end of the term, if I'm putting that money aside into these funds and into the pension, then hopefully I'll have a substantial amount to pay off each of the properties. So how am I planning this out? Right guys, so I'm not chucking a random amount in this fund each and every month and just hoping for the best. I've actually got a spreadsheet and it's literally got all of my properties on there. It's got other things as well. It helps me sort of manage my properties so I can keep track of when all of my rental agreements need to be renewed, stuff like that, when the EPCs were done, when the electrical certs were done. And I've also got a tracker on there which tracks the amount that I want to be putting aside each month so that I can build that up to then pay off each and every mortgage. And I can also sort of put a copy of this or put a link to that if you're interested in this as well, having a copy of this for yourself. Just put, I don't know, property plan in the comments below if you're interested in having a look at this. So say for example, and these are all example figures that I'm going to be spouting out here. So say for example, if I have a £200,000 interest only mortgage, and let's say that's over 25 years. So at the end of the 25 years, I'm still going to owe the £200,000, right? And if I put aside, for example, £500 each month over the next 25 years, and then assuming for roughly about a 7% return on that, I could then potentially grow this to maybe £250,000 or even more. And that's in the 25 years. So when I'm putting the money away, I'm not literally relying on investment gains solely. I'm hoping to build the amount from putting the money aside each month. So the investment gains are just going to be a bonus for me. So that's potentially without factoring in the market gains. So that way, even if returns are lower than expected, I am still covered, hopefully. And guys, yes, this is hypothetically speaking. I'm not an expert in investment funds and hedge funds, and I'm not a financial advisor. So yeah, this is just something that I've looked into from a little bit of research that I've done. However, if you do want to look at your finances and you do want to speak to a financial advisor, then you can use Unbiased. The link is in the description box below. And if you do click on the link, you'll get your first consultation for free. And Unbiased, literally, they are like a matchmaking service for your finances. So if you do need a financial advisor to speak to, they will match you up with the perfect financial advisor for you. And guys, I do make a small commission from everyone who signs up, so thank you. Yeah, so I'm not a financial advisor, guys. This is something that I have looked into and researched, and I thought I'm going to do this, and I thought this would work for myself personally. So please make sure you research this yourself and look into everything before you do it. So yeah, guys, I mean, let's be real, this strategy, it's not perfect. So let's look at the pros and cons. So pros, it could keep more of your cash flow open to you when you compare it to having something like a capital repayments mortgage. And therefore you've still got the flexibility of having those lower payments on the interest only, but you know that you're still covered and you're still putting that money aside for later on for your exit. Another pro, potentially you could be building up a great retirement or pot of money there alongside knowing that you're going to be paying off the mortgage completely. And another pro is, again, it's the flexibility. So if the market does do well, even though at the minute it's kind of filming this video, it's kind of tanking, but if the market does start to improve and things do get better and the market eventually does do really well, you could have the potential to pay off the mortgage even earlier. Again, it will still be way in the future, but potentially earlier than the mortgage term that you originally signed up to. So cons, guys, it's a risk. It's a massive risk. As with all investments, it comes with a risk. You're not guaranteed the returns. You're not guaranteed anything. Another con is that it requires a lot of discipline. So when you do see the money coming in, you've got to have that disciplined approach to actually that portion of your rental money each month aside. And again, the spreadsheet that I've got for all of the properties and sort of in how I manage my properties and things, I've actually actually calculated how much I need to save out of that rental income each month and put aside so that it covers it in 25 years, 30 years or whatever. I think I've got 25 years on mine because I'm hoping to have an earlier retirement. I've got more videos coming on this as well, guys, so stay tuned to the channel. But yeah, you've got to have that discipline so that you put the portion of money away and hold it back for yourself. I mean, you should be doing this anyway, obviously for tax purposes, but you need to have that discipline to put that portion of the rent aside for later on. It's delayed gratification. It's knowing that you are delaying the gratification of having that money now for later on. You can always automate it if you want as well and just automatically get it to come out of your business account or wherever you're paying the rents in, which again, that comes with more sort of tax benefits as well. But yeah, but again, guys, I'm not giving you any tax advice or anything. This is purely from my experience. But I think for me as a smaller landlord or a smaller investor, it could be a game changer because I'm already thinking about my exit and how I'm going to plan, and I'm not going to be left with that massive lump sum payment at the end of the mortgage term. I know I'm already thinking about how I'm going to be covering that from now. And I'm also not relying on that capital appreciation, which should happen with properties. I'm not relying on the property prices to increase over time. So then I can use some of the potential equity that could be built up into the property to pay or, you know, to offset against the outstanding mortgage amount. And with the way things are going with government changes, tax changes, increases and things like that, hopefully that is going to help mitigate against all of that as well, because we just don't know what the government's going to do, you know, in the future. If there are more and more tax hikes and taxes that could really affect us as investors moving forwards, at least I know from now I've got that money set aside to help against things. And I just feel like it's helping me take back control of my property investing finances, and I'm not solely relying on capital appreciation or the sale of a property to pay that off in the end. And honestly, guys, what's the worst that could happen? It's just worst case scenario, I've got another pot of money to sit on for my retirement. So it's a win-win situation all over. So guys, if you do want to implement this strategy as well, a couple of things that you probably just want to think about is just things like knowing your numbers, know what's going to be outstanding or owed at the end of the mortgage term so that you can then set a realistic monthly contribution to pay that off in the end. Choose the right investment fund for you. Be consistent, set up a direct debit if you need to, and just treat this like it is maybe a mortgage expense or another expense for you. And make sure that you are adjusting over time. If you feel that you want to put in more, adjust the amount for more. If you want it to be lower, make it lower. That is the beauty of this, is that you're not set to a set amount. It's whatever amount that you want to put aside. And like I said, what is the worst case scenario? Worst case scenario, you've got another pot of money set aside for your retirement. Best case, you've got a fully paid off property and you've got that financial cushion. How to save your first 100k from nothing: property, investing and budgeting. Let's get into it. All right, guys, let's talk about hitting that first milestone, that 100k. And before you say it, Sabrina, guys, you are right. 100k means nothing. It's not about that. I'll talk more about why later on in the video. Let's get into it, guys. Guys, so I literally started doing all of this property investing about 3 years ago. So I know how hard it is to start out, and this is the reason why I'm making this video as well. I literally started from nothing and I used all the tips that I'm going to show you. I implemented that into what I was doing, and this is how I've got to where I am today. And guys, I'll let you into a little secret as well. Most of that money is all tied up in property. It's not exactly in my bank account, but yeah, let's get into it. Yeah, so I can forget about that trip to the Maldives. Right, guys, so in order to save anything, what we need to do is make sure that our financial foundations are sound and safe in the first place. And again, guys, I have a financial plan. There's a link to that in the description box below. And this is something that I'm really, really passionate about. We don't learn enough about how to manage our finances in school. We kind of are left to our own devices and just chucked in the deep end and just waved on and hope for the best, basically. So guys, first things first, we need to make sure that our financial house is is in order before. So if we've got a lot of crippling debt with high interest rates, we need to have a plan to tackle that and pay that off before we begin to think about saving, investing, and so on. Once we've then done that and we've sorted out all of our debt, then we need to think about building an emergency fund just in case the worst should happen. We want to have at least 3 to 6 months worth money that is put aside in an emergency fund in maybe in an ISA or a high interest account that we cannot get to only if an emergency happens. And I'm not talking about I need a new pair of shoes or this has happened. I'm on about an actual real life emergency. Something's gone wrong with your car. You need to, heaven forbid, you lose your job and you've got that money there so that you know that things can keep going for the next 3 to 6 months. And I'm guilty of this myself. I literally had no idea on my finances, and as soon as the money would come in, it would just slip through my fingers and go back out again. And yes, I spent it on those shoes. And as well, budgeting like a pro. And budgeting, don't think of it as this really mundane task or really boring task. Budgeting is all about knowing exactly where your pennies and pence are going. It's really worthwhile knowing this, so you know what you're spending things on, when things are coming out. That's an important thing as well. It's knowing when certain direct debits are coming out so that you are prepared that the money is there and it's not going to be touched, so that you've got that delayed gratification and your money is there and you've paid off all of your bills. Now, guys, there is a link in the description box, and it is to a financial plan, and it covers things like this as well for you. There's a debt plan in there if you have got debt that you're trying to tackle. There's also on that financial plan as well, we've also got a budgeting for you, and I've also done it so that you can see your monthly incomings and outgoings, and also you can work things out daily as well. Again, it's worthwhile knowing when things are coming out, when your direct debits are coming out. If you don't know any of this, things could be coming in and out of your account. You could get bouncing direct debits, which will bounce back in and back out again, and then your bank will charge you, it just adds up to this spiral, and it's something that you'll find it hard to get out of unless you look at things and break it. You might have to break it down day by day. If not, there's a monthly one in there as well. So if you want that is completely for free. And again, this is something that I'm really, really passionate about. The link's in the description box below. And then once we've sorted all of those out, so you're literally as strong as anything, you have your debts all sorted, and you've also got your separate emergency fund there, then you can start to maybe build up some investment pots as well on the side. And this is where all the fun happens. And if you do start investing in something like a stocks and shares ISA, then over the long run, you can start to benefit from that compound interest. Again, I'm not an expert in this, so if you do need some advice, please speak to a financial advisor on this, and also do your own research. And if you do need to talk to a financial advisor, you can always use Unbiased. It's like a matchmaking app for your finances, so they will literally put you in touch with whatever you need. If you need to speak to a financial advisor, they will put you in touch with a nice financial advisor for you to work with. You can get your first consultation for free, and the link in the description box below. And yes, I do make a small commission of everyone who signs up, so thank you. So do your research on this. There are loads of gurus who know a lot more about investing in stocks and shares and things like this on YouTube, and they can give you a lot more advice on that as well. But for example, the way I look at it is, if I do put my money and save and put that into either the stocks and shares ISA, and also build up my pension pot as well with someone like either Vanguard or Invest Engine, apps like that, or even Trading 212. So then in my mind, not only am I saving and it's away, it's safe, and I'm not thinking about it, I'm also benefiting from any investment returns that I might get on there as well. Obviously, you can also lose as well, but you can also make as well, because with this, it is almost like our property investing. It is for the long game is what we're playing. So over time, even though there's highs, lows, dips, whatever, over the whole idea is that over the long term, hopefully, fingers crossed, should come on top. But as I said, yeah, please do your research on this and look into it further. So the next step as well is that you can actually build and save up some sort of deposit or something using some of these schemes as well, and then you can use that to invest in property, which is what I love, and that is what I really, really am passionate about. And that's here, and I've documented my own property journey here on my channel. So if you are liking stuff like this so far, then please like, comment and subscribe if you want to see more videos like this from me. So yeah, I love property and I'm using that as a main chunk of my investment is in property. I'm diversifying that at the minute by adding with some of these other investment funds as well, but I'm hoping to build most of my wealth and generational wealth that I can pass on to my children through property. The cons of this is that obviously it's not liquid cash. I can't just take the money out right now and then just go on a massive shopping spree or go on a load of holidays. That's a good thing for me because I just don't want the temptation to spend. So the best way to save if you are here in the UK is to put your money into an ISA, whether it's a stocks and shares ISA, cash ISA or a lifetime ISA. That is one of the best ways for savings, to put your money into that. And what I've been doing is using the stocks and shares ISAs, so then I can invest in things like Vanguard, index funds, ETFs and even single stocks and shares and things like that. And then the idea is then to let compound interest do its thing and just compound and compound for me. And obviously you've got all the tax benefits as well. So at the current time of filming this video, having that £20,000 cash allowance that you can spread out over your various ISAs. And again, there are loads of videos on this on YouTube that you can look into from experts that go into more detail and that can explain in more detail than I can. But yeah, you can literally, the tax benefits from it are really, really great, brilliant, unless the government changes anything. But yeah, guys, going back, my first point, as I said before, that 100k, that is just a figure. That is not the most important thing here. The most important thing is building up those habits. This is something that we're literally not taught about this in schools. It's building that habit of saving and what goes into that habit of saving as well. And again, I've got videos on this, on the tips and things that I used to help me save and put money aside. But the main thing, it's not about hitting that 100k. It's about building those habits and setting yourself up for really, really great financial success. And as I've said, it's something that I'm really, really passionate about. It's really, really important to have that financial stability. You just feel confident. And guys, watch this video next so to help you save for your retirement. How to start saving money and investing for your retirement. Here's my step-by-step guide. Hi guys, right, so I have been actively investing in property for the last 3 years, and I mainly do this by investing in commercial properties and then converting them into residential. But before I was able to do all of this, I had to get all of my finances in order. And this is exactly what I did to get myself where I am today, at the point where I'm able to actually actively invest and watch my money grow. So today we're going to talk about something really, really important, and that is how I actually started to invest for my retirement. Yes, it sounds like a long way off, but trust me, your future self will thank you for what your present you is going to be doing. And I've also got a fun challenge which I'll talk about more in the video, and also a free tool that I use to help manage my money, manage my finances and all of my debt plan, my retirement plan, my investing plans. So, and guys, I'll be doing this all along with you through examples, and we're going to break it down and do it step by step. So grab yourself a coffee, grab yourself a tea, and let's get comfy and let's get into the video. And guys, I'll be splitting this video up into manageable chunks. So first of all, we'll talk about paying off your debts, building an emergency fund, secret savings challenge, we'll say, and also beginning to invest. So feel free to skip through to whichever sections suits you best. Okay guys, so step one, paying off your debt first. Now this is something that I had to tackle and that I'm really extremely passionate about. Before you even think about investing, saving or anything like that, we need to get these quick, easy wins out of the way, and that is paying off our debt, especially high interest debt. And this is basically literally 100% return on your money, because whatever money you have put aside that you're going to put and pay off this high interest rate, instantly that money and that debt is wiped out as soon as you've tackled that debt. So for example, if you have a credit card which possibly could have a 20% interest rate on it, every pound you pay off of that initial debt is a pound that you do not have to pay in interest. So it's literally a win-win. Now, I've been keeping a little secret from you guys, or some of you might have guessed, I don't know, but I've literally updated the free financial plan that I have linked in the description box below. It's got a free savings plan, it's got a free debt busting plan, and it's also got a free investment plan. So if you go to the link in the description box below and download the plan, I'm just going to run through this with you. So our first step, as I said, is to pay off our debt. So let's go and have a look at the debt repayment plan that I have on this tool. So if we go here, the first tab that you'll see is the debt plan. And as soon as you open that up, because this is our first step, this is step one, is repaying off these debts. So what you'll do here is you'll list the debts that you have. This is a quick description of them. So if you've got, I've ordered them in prioritization. I've actually ordered them in order of highest priority. So as we look on here, I've got loans first, then credit cards, then overdrafts. Feel free to change this as you want. These are all example numbers. So I've put in the monthly payment that you might have, include this, and this will probably include all of your interest and the total amount owed. And what you can do here is phone up, give the company a call, and literally ask for a settlement figure, and they'll send you through something, and they'll say, if you pay this much within this amount of time, this is the offer that we'll give you, and this is how much you'll pay. So if you get that, pop that in here and literally prioritize all of your debt in order of the highest interest rate first. I would assume to put in here, so we can tackle that high interest or highest figure, the most that you're paying each month first. Pop that in there, the name of the lender and the payment. And if you go over here, this is all linked. So your debt one on this side, you've got your repayment trackers. So if you'll see the debt one, you can pop in your monthly payment here and the payment that you actually make. And what's great is if you click on this, what you can put in here is if you make an extra payment of say £100, input that, and you can see how much you've actually made and that extra payment. And stuff like this is a quick win for me. This gives me an immediate dopamine hit because I can see I've made an extra payment of £100, and then that gives me the motivation to keep going and making extra payments as well, which then in turn means that your term is going to be shorter and you'll get that debt paid off quicker. And then as soon as you've paid that one, the highest one, then if you move to the next one that you've next prioritized next, and then do the same thing, so that money, before you even get used to the money being in the account, you pay it off onto the next loan and the next loan and the credit card, for example, credit cards, or whichever. If you've got overdraft, you've got an overdraft. And the idea is it's almost this snowball effect, which obviously others have, and then you get this snowball effect whereby you actually see this, and it motivates you to keep going. And also as part of step one, and I've already talked about this in other videos as well, is that you would have wanted to have listed out all of your incomings and all of your outgoings so that you've got that all listed down. And as I've said in past videos as well, as part of this finance tracker, you've also got a space here as well where you can list out all of your income and also all of your outgoings. So that's all included as well. And I've updated all of this as well for you. Okay guys, so now that we've tackled our debt and we've actually got that plan in place to tackle that debt, now it's time to build that cushy safety net. You know what I'm talking about? It is our emergency fund. Now, we do not touch this emergency fund. No matter what happens, this is literally just for emergencies. We've got other pots available to us for other things, which again, I will discuss this later on in the video, so stay tuned. So again, like what I was talking about earlier, where we use this almost snowball effect, where the same money that's paid off one debt, as soon as that debt's paid off, we push all of that money into the next debt that's on the priority list. This is the kind of what we're going to keep that idea flowing through for here as well. So that same money that we would have used to allocate and pay the debts off, now we're going to use that to build up our emergency buffer, our emergency fund. And ideally we want 3 to 6 months worth of expenses. Now, I also use this method for my investment properties. When we come to the investment part, I will discuss that then as well. For my investment properties, I have a certain amount left, almost like a pot of money for each property for any emergencies that may crop up with any of my rentals. And by the way, talking of properties and rentals, my name's Sabrina, and I am literally tracking and documenting the whole of my property journey here on YouTube. So if you're liking this type of content, please subscribe, like and comment. Thanks. So Now we have built up our emergency fund, let's get on to our next part, which is actually savings. So now here's the fun part, and this is where, and I want you to bear with me because this is all about building habits. So the little challenge that I've got, and I'm going to do this as well, guys, with you, is I'm going to be doing a savings challenge. So we're going to start small and it's going to end up building and building on itself. So for example, week 1, let's put aside £10, right? That's a meal deal at Tesco's, the best part of a tenner. Let's put aside £10 into emergency or into our savings part. Then in week 2, we're going to put aside £10 again, but we're going to add £2 onto it. So £12 in total for week 2. And then we're going to do the same thing for week 3. So we're building on what we've done in week 2. So we're going to take the £12 and we're going to add another £2 and we're going to put aside £14 and so on and so forth until we get to the end of the year, hopefully 52 weeks. And hopefully by the end of the year, we should have saved up close to or over £3,000 just by using that method. And bear with me, guys, the reason why I'm saying this, it's not so much putting the money aside. So if you can afford to put more in, put more in. If you are still sort of building up and getting out of the debt phase, and if you can't afford to put in those amounts, that's fine. Put something aside, maybe £1, and then the week after add another £1 onto that. So you've got £2 and build like that at first, because the key thing, it's not the amount that we're building, it's the habit that we're working on. So by the end of the year, hopefully that will, by putting that money aside each and every week, it will reinforce that savings habit in your head. And this is something that I struggled from quite a bit as well. I used to get my paycheck and just blow it on everything. And that's another reason why investing for me has started a lot later than what I could have started doing investing with. So yeah, for me, investing, that phase of my life, I've started a lot later than what I potentially could have started because I hadn't built up those healthy habits, those financial habits, those habits of saving and building that strong foundation first. And it's something that I have built up now, but it took me a while. So guys, like I say, the focus here, it's building that habit of saving and not blowing your whole paycheck, which is something that I used to do. I'll hold my hands up, that's what I used to do. So the good points of this, it's slow and manageable at first, it builds up a habit, but obviously the worst the points are towards the end, it's gonna get more and more, it's going to build up fast and get more and more difficult to put it aside. But hopefully by then it will have reinforced that whole saving, and it will be almost like a reflex thing, motion that you do, putting that money aside to save. So yeah, feel free to tweak if you need to. Consistency is the key here. It's building that habit. And again, if we go back to the finance tracker that I have on the financial plan, and again, one of the tabs on the financial plan that I've got here, you have a section here where you can pop in, so you can put in all of your transactions that you have, everything that goes in, everything that comes out. And also on this side, you've got handy savings trackers. Now, what really helped me was having different pots for different things and thinking like that with my money. So actually managing it and having different pots for different items. So you can actually track like a general savings fund, your retirement fund. This, in my head, this was something like your Vanguard investment funds, things like that. If you've got children, you can sort of save a bit of money there for your children. And this is the emergency fund tracker. So again, what we were looking at before, tracking how much you've got in your emergency fund. And then here's the nice part. Literally, I have a separate pot where I put all my fun money, and whatever I want to do with that, just travel, going places, seeing the world, just putting. So to me, fun money is travel, it's doing nice things with, it's just money set aside. With the main thing, this pot of money is money for me to spend guilt-free. So I'm not panicking and thinking, I shouldn't, doing this. It's not all about being so restrictive with your money where you can't live your life. It's just about getting your money in order. It's about ordering your money. So this fun money, you can spend this guilt-free. And then again, if you're saving up for a special item, maybe saving up for a car, maybe a bag, something, you can put a special item fund, and that's the money that goes into here. You can save up for that. And you can literally track your progress with this as well. So that's in here as well for you. So again, you've got your target amount and your actual, if you put in extra payments towards that, and then you can see the difference. And again, like I've said before, if you're anything like me, when you make an extra payment and you actually see it on something like this, like a spreadsheet, it gives me that little dopamine hit, that motivation to keep going. And guys, this is a bonus tip as well. What I've got here is for every single month, all the way up to 12 months. And what you can pop in here is, and this is literally something that I've said in other videos, is you can track when direct debits come out of your account or when you make a spend at certain times of the month. So you can see how that would affect you. So for example, on here, mortgage payment, that comes out in this time of the month, and for an example amount of £800. But if I go to Zara and spend £500 in that month, I can see how that's going to affect me. I can see so doing it like this just allows you to make adjustments as you're going along throughout the month as well. So if you might find that you might need to change the date of a direct debit based on when you're going to get paid and when you get money in, when your money comes out. So I'll link the past videos as well. So this might just help you so that you can adjust direct debit dates, so that you can make, for example, your electric, maybe you get paid on the 1st and you want your electric bill to be paid on the 2nd, so that it just goes, as soon as it comes in, it's gone. And as soon as your money comes in, all of your priority bills are paid. Or maybe you get a second payment throughout the month as well, and you want to adjust your direct debits coming out based on that too. So it just allows you to do that. And again, I've discussed this in past videos. Pay off your high interest debts, build up an emergency fund, and have a plan towards saving. And then it comes to the best part, which is investing that money. Now you've got a plan for your debts and you're debt free, you've built up your emergency fund, and you've also built up that savings habit. So guys, it's now time to put that money to work by investing. And I've built up a lot of wealth by investing in properties. My plan is to do this by investing in commercial properties that I convert into residential. And if you're wondering how to do that, watch this playlist next, where I do just that on my last project. And guys, let me know what your biggest money goal is this year. Pop it in the comments below and let's have a conversation. And guys, a little reality check. Obviously, with properties, it can either go up or down. It's like any investment. They're not always guaranteed. You're not guaranteed to double your money. Nothing is set in stone. So please make sure you do your research, ask professionals, and get some advice. Powerful property investing strategies to escape the 9-to-5 and unlock financial freedom. This is how property investing can transform your life. Let's get into it. Property can be a lucrative venture, and it can also provide you with long-term wealth. And there's various property investing strategies so that you can leave your 9-to-5 depending on your circumstances. And I'll discuss these strategies in this video. Some of the strategies that I will be discussing later, I've actually used and I've seen great results. And I'll also go over some general property investing tips that I've picked up along the way towards the end, so keep watching. So some of the strategies that I've come across are some of the ones that people always talk about. There's deal sourcing. You can also do rent to rent, serviced accommodation, and HMOs. Now the great thing about these type of deals is that if you do, especially if you do the SAs or the HMO route, if you do that, utilize that through doing a rent to rent term, then you can actually do this with very, very little money. If you can source like a rent to rent contract or a lease option contract, you can actually do the SA, serviced accommodation, or you can do a HMO, house of multiple occupation, through those means. And you can do that through putting in very little money on your part. So if you actually combine rent to rent with serviced accommodation or house of multiple occupation, you can actually get yourself a rent to rent deal whereby you rent that from the estate agent or the vendor, and then you implement your strategy into that, and then, which is, as I said, can be either a HMO or serviced accommodation. And then the idea is to rent that out again almost, and then get the money back to cover the rent plus a bit of profit. There's so many videos on YouTube about serviced accommodation and HMOs. I'm probably butchering. So a HMO HMO is where you literally have a property and you split that up and you rent it out on a room by room basis, and that way you can maximise your profits from it rather than sort of renting out on a single let. So you're actually maximising the profit that you can get from this one property. So that'll be a pro for HMOs, is that you can actually maximise your profits. You're supercharging your profits, so to speak. So you're not just having a single let, you're actually splitting up the property and renting them out on a room by room basis, which means that you're actually getting more in rental income from one property. Also, a con is you've just got to bear in mind that the more people that are in the space, the more likely it is for problems or, any disagreements or conflict to arise. And you're also got to watch out for void times as well, when people coming in and out over time. So it's going to be more labour intensive for you. You've also got to be careful with HMOs, because you've got to make sure that the area that you're looking to do a HMO in, you've got to check the Article 4 planning requirements for that area. So here in Nottingham, if the Article 4 direction is, there's a map of that over Nottingham, and within that area you've actually got to make sure that you have a HMO licence. So obviously you'd have to apply to the council to get a change of use for the HMO use, so that you can use a property as a HMO. And they are quite strict on that at the minute with planning. It actually even states on their websites that it's very unlikely that you'll get a new licence or you'll get planning to do a HMO on a certain property. But you can always check with the local planning advisor and just see how they stand on that, unless you have grandfather rights. So if you've had a property that you can prove, or that has been let out to a multiple let, for example to students or as a HMO in the past, and it's been like that from before the Article 4 direction came into place, then you've got grandfather rights and you can still use that building as a HMO. Or you can get a property that would be just outside the HMO Article 4 area. There will be guidance on the local planning authority website, so if you check that for details, or you can give them a call just to get a bit of guidance directly from them. And the next strategy is serviced accommodation. So again, if you can combine that with rent to rent, if you can get a rent to rent deal and then let the property out on a serviced accommodation basis, that can also maximise your profits as well. So with serviced accommodation, it would be similar to a HMO, however you'll be letting it out on a nightly basis. So you'd let it out on Airbnb, for example, on a nightly basis. Another strategy is to joint venture. So this will be where you team up with somebody else. Maybe they've got a set of skills and you're an investor and you've got a load of cash to spend, or maybe it's the other way around, vice versa. You joint venture with an investor who's got quite a lot of cash capital, and maybe you've got a lot of skills that you can put to use, like for example project management skills, or maybe you're good with trade, or maybe you are a trade. Then you can team up, and then you can also make your money or their money go further and actually get further along in your property journey by teaming up and joint venturing with someone. And another strategy would be the BRRR method: buy, refurbish, refinance and rent. And that is a strategy that I love. That's the one that I've been doing at the minute, and it has really been working for me. So once you've done all the others and you've built up a little bit of a cash pot, you can go into that, or maybe you've got a cash pot already set aside. If you go into the buy, refurbish, refinance and rent method, and it's a really good way to keep going on your property journey, and you can link that into all of your property goals that you've set yourself. So I love this method because unlike all of the other methods, or rent to rent and things like that, rent to rent, unfortunately, what I dislike about rent to rent is that you're actually building a business around somebody else's asset, and that could be taken away from you at any time, regardless. I still personally feel, regardless of whether you've got a contract in place or not, if a landlord or someone wants their property back, they're probably going to find a way to get it back, and then once that's gone, your income's probably gone with it. So this is why I love the buy, refurbish, refinance and rent method, because that involves you going out and you actually purchasing that asset, and that's going to be either in your name or your company's name, and once you've got it, you have it. So it's better I'd prefer to build a business around an asset that I own or own on paper rather than somebody else's asset. So yeah, you obviously with this you will need to have built up a bit of a cash pot to act as your deposit and to pay all of your fees, and also to pay to refurbish the project as well after. And I've actually done quite a few of these deals, so I've done them by either getting a bridge loan and then going on to a buy-to-let mortgage after refinancing and then pulling out the money, or I've done a bridge to let, which I love, and I've got quite a few videos on bridging loans, bridge to let, bridging funders. I've created a whole playlist, so I'll link that in the description box below as well. You can watch that. So what I love about this method is that it allows you to actually add value. Once you've added value and you've solved an actual problem, for example, you brought a property on a bridge that is not habitable and can't go straight onto a buy-to-let mortgage, so you've used a bridge to purchase that property, and for some reason maybe there's no kitchen, there's no bathroom, or maybe it needs a total modernisation, or if there's other issues in the property that you potentially feel that you can solve and you can fix, that's your way of adding value. And once you add value, that's going to convert into profit. Once you then go on to refinance that property as well and pull out the money, and then that's how you can then go again. So you can see how that can quickly build wealth for you, and that's wealth based around an asset that you own. And a little tip for this, just so that you know that you are focused and you are purchasing a property that's actually going to help you succeed and go further on in your property journey, is if you sit down and almost say to yourself and put down on paper almost like a property avatar or a property criteria of what you want to buy. Therefore, as I said, then you're going to be more focused when you're looking for properties or you're sourcing properties, more focused on what you're going to buy. You know how much you're willing to pay for the property as well, so that you can negotiate well and you can actually come out with a property that actually meets your needs, and it's going to keep you going with your property journey long term. And I do have other videos on that as well, on your perfect property criteria, which can help you be more focused when you're actually looking and going to purchase properties. And that leads me nicely on to property investing tips. Number one, just make sure you educate yourself, that you are reading books, you are looking into forums, you're joining Facebook groups, you're joining LinkedIn groups, you are looking at the UK property market trends, interest rates, maybe you subscribe to a load of things on YouTube where they're discussing all these things, just so that you can stay in the know with market trends and you can stay one step ahead. I'm currently reading Atomic Habits, and I've also read Know Your Why by Simon Sinek as well. That's great, so that you can actually be more focused and you know exactly what you're doing. You've got goals that you've set yourself and you know why you're doing this in the first place, so that you're motivated to keep going and actually go through with the goals that you've set yourself. And part of knowing your why, you need to know what your current situation is. How do you stand financially? What do you need to improve on your financial matters? Do you need to improve your credit score, for example? If you do, what do you need to do to improve your credit score so that you can actually go out there and get the best rates possible for you if you're going to go for that BRR method? Again, I've got videos where I've shared tips and tricks that I've used to help me improve my credit file, so that then I've got good enough credit file so that I can go out there and get really good mortgage rates and deals. Another tip, consider outsourcing where you possibly can. If you can outsource to a property, like a maintenance manager or something, speak to a local estate agent, especially if you're remote investing, that is going to be key for you. I tend to stick to being around Nottingham, but I am looking into a maintenance company or contract with an estate agent, just so I can get that help to maintain the properties that I've got. It just helps you. If you're outsourcing, it will save you time and money. That time and effort, you can put that into strategically overviewing your business and steering your business in the right direction, your property business, if you're saving time. So anywhere where you can outsource, have a look, run the numbers, see if it's going to be beneficial to you. If it is going to be beneficial and you can outsource it, and keep track of your cash flow. That will be my next tip. So whether you're doing a renovation project, whether you're trying to keep track of your rental incomes, maybe you're trying to keep track of everything as to when things need to be maintained, gas safety certificates, things like that, when they need to be renewed. Just make sure that you are keeping track of everything on some sort of spreadsheet. I do have a link in the description box below, and it's to a project plan and also a financial plan, so that can help out with that. Like I was saying before, the financial plan, if you need to improve your finances, that can help you to map out your current financial situation and what you need to do to improve. And the project project plan will also help you to actually run your project. So it helps you to input how much you've paid to trades, for example. It will help you to keep track of finances that way, and it will also help you to literally see, it's got a scope of work sheet or a specification sheet in there, just so that you can detail everything that you need to do on a renovation and hopefully put a cost towards it, so you've got an estimated cost. And it'll also help you to think about putting together a risk register of items that you need to look at when you're first sort of analysing a deal as well. So if you first come across a property and you think, right, I might need to put a new roof on that, you can pop that in the risk register with an amount next to it, and that will add up to an amount there that you can have separate to your contingency and separate to your actual budget amount, just in case the worst were to happen and you were to do a new roof. You know, part of that budget is set aside for that item. So that's in the description box below, guys, so you can download that, and it's a free Excel sheet as well, so that's there for you to keep. Also, make sure you're doing thorough inspections of properties, thorough viewings as well. I've also got a video on things to look out for when you're viewing a property that can give you some tips and tricks to what look for when you're actually initially looking at a property. Another thing, and I've fallen off from this myself and I need to pick that up, that is a goal that I've set myself for this year, is going to networking events. It is so beneficial to go to networking events on a regular basis where you're meeting like-minded people that will actually motivate you and keep you going on that project even though you've just met them. Just by going to these things, it's like you're meeting kindred spirits or something, other people that are actually interested in the same things that you are. And again, you could probably get joint venture deals from networking and meeting people and speaking to people and being confident and just actually talking to people about the stuff that you're doing, the stuff that they're doing, seeing how you can help each other out, and you're actually learning stuff as well from these networking events. Like, I've been to quite a few in 2022 and 2023. I've been to a few Steve Hamilton's free events, and they've been so good because again, you get to just meet and mingle with people that are on the same vibe as you, and you can help each other out, you can pass information back and forth, and it's just a great place to be. So yeah, going to networking events, that's something that I really want to be doing a lot more this year, because I've not been able to for a while now because I've been so busy doing some of these renovations, but I do need to get out there and see people. And always as well, seek professional advice on everything. And when I say professional, it don't just mean people with qualifications. It could be someone or an expert or somebody that's done something for a certain amount of time and they've got a lot of like practical tips and tricks and expertise or experiences that they can pass on to you. So yeah, just build that team of people around you, speak to people, talk to people like myself. We love speaking to people about this subject, so just reach out and talk to as many people as you can if you are unsure. But just one key thing as well, just make sure all of your socials are up to date and you've got them there, because that is it's almost like it's your interactive business card. And so if you do go to these events, you can just scan your QR codes and you've got the other person's details in your phone. And I will be doing more videos on how to sort of automate your social media as well, especially if you're like me and you're the only person that's in your business at this moment in time. Your time is precious, so if you can automate anything, and as I said earlier in the video, if you can outsource anything, this is one thing that you can outsource, and the videos coming soon on that, guys. So what are your feelings on that, guys? Just pop them in the comments below. Remember to like, comment and subscribe, and watch this video next if you want a few more tips on how to avoid a down valuation. Thanks, bye.